Richard Madigan. The numbers out of China certainly put a floor under this market today. Do you want to buy China? What do you think the numbers out of China tell us?
So for me, I'm not a China buyer. I think if you want to be in the Pacific Basin, you look at kind of the secondary countries. You look at Taiwan, you look at the Philippines, you can look at Malaysia. I don't think China is the spot to be. I'd much rather be secondary in the emerging market space. And clearly, China is trying to take a 747 and land it on a postage stamp. They don't have the debt. They don't have the leverage that we have here. We had here in pre-crisis, but they're certainly trying something that has never been done probably on Earth. So yeah. I'd rather be in other countries than China.
I understand, but I guess just the level of growth, does that help the rest of the world, Richard?
So I was going to say, can I hit on this one? So China is the thing that is talked about the most and understood the least. Saturday, I'm getting on a plane. I'm spending all of next week mainland China, meeting policymakers, leadership, business leaders. Following week, I have my whole senior team in Hong Kong and Singapore. We're doing a deep dive on the region. We love that region. Growth is real, earnings are interesting, so markets like Singapore, Korea, Taiwan, a lot of interesting opportunity. China's tough to invest in. There were sectors last year that were up 60 and 80% in the new economy component of China. But the trick to China is this rotation that is happening, and they're all in. So the most fascinating thing to me, closed capital account, $4 trillion in reserves. They are going to reposition what is happening in terms of what drives growth. Their biggest fear is 3 years from now they rebalance an economy and don't get consumption. But they can afford it. They're going to push it. They're really aggressive about it.
Well, I think that's an important point, because they are transitioning from a producer of the world producing products to an export economy to a consumer economy.
And lower growth. They've said this. It's so funny. The debate on the nuance of 7.3 versus 7.7%. If they've said 7.5% this year, they're going to grow 7.5%.
Right.
It may be bad growth. They've also told you they're transitioning to 6% growth. So as they broaden out their developed economy model, they can't afford to continue to grow at that pace. Look at, and I'll stop on this, look at the Asian tigers, 80s through the 90s. 12%, 10%, 5%, 3%. That's where China's going.
It's funny, we used to talk about the Asian tigers, now we're talking about the fragile five.
Yes.
Okay, so that's a sign of the times.
And
China not one.
I think that's the key with China, is that they're trying to engineer expectations around the globe that, listen, we're no longer a 12% economy or a 10% or an 8%, but we're on our way to 4, 5, and 6%. As long as the global markets have time to digest it and get used to it, it's fine. It's when you fall off the cliff where we can't adapt so quickly.
Yeah. Well, I mean, if you see China growing 7.4%, and relatively speaking, I mean, that is fantastic growth. I mean, relative certainly to the U.S., where we're at 2 or 3%.
Yep. Or Europe at 1.2.
Or Europe. So is that a reason to buy companies that may have exposure to China?
Companies, yes, right? I think you've got to pick them, and the Ford segment was brilliant on that, because what you're watching was a view a year ago that it was luxury driven, and what it's becoming is much more provincial as they create a middle class. So basic consumable items have become really interesting, and that development component in China may ironically help U.S. exports out over the next 5 years.
You said earlier that we are entering a different phase of this market, that perhaps it's the beginning of the correction, or the beginning of sort of, you want to sell into the gains. What's your timing on that? And what are the factors that tell you that we are, in fact, looking at a fragile story here?
So I think the bull market is, in a healthy fashion and in a routine and normal fashion, transitioning into the next phase. Usually when you transition, you see fierce sector rotation. We talked about it earlier. Yep. We've seen that with the internet, with the social media, with biotech, with
sell momentum, buy value.
Right. For me, I bought some of the high flyers yesterday. I bought biotech, I bought internet. Yeah, because I think that first rubber band snapback is where you can make some decent money and your risk is relatively low. But I think the next phase of the bull market, leadership is going to come from energy, is going to come from commodities, is going to come from REITs. We've already seen utilities have an enormous run for utilities. I clearly would not run out and buy utilities today. Staples, which used to be a U.S. only play, now have exposure not only to the developed world, but huge emerging market exposure now. So this is, to me, a normal transition in a very old, wrinkly, but still healthy bull market.
You had asked me, Maria, at the beginning, what are we telling our clients right now? And I think the big push over the last 2 years was get in the markets. Markets are on fire. We actually think that there is growth, there's sustainability, there's value, things were cheap. And the good news in that is we got paid for that beta for 2 years. The challenge this year is, as you're getting further along in a recovery, you have to reconcile the fact that the returns aren't as exciting. So you're not going to do 30%. You're going to do 5, 7, 10. But it creates a different set of opportunities. So if last year was about establishing base positions, this year, per Paul's comment, there's an awful lot more to do in trading. You can be a lot more dynamic in this market because the rotations in active selection are going to be the differentiator between a market return and a higher than market
Like
return.
what? What's the rotation that you would recommend?
Well, what's funny, even some of the cyclical component of it, the value growth debate that's happening right now, I think, is an oversimplification of where we are in the cycle. Growth tends to outperform when you're bouncing from a weak part of the cycle because you're paying a premium for growth. There should be a natural rotation into value as it gets a little bit further extended. But value, to me, ends up being, from the sectors you talked about, a defensive cyclical debate, not these boxes that we construct on growth value.
Yeah.
They change.
And to Richard's point, I think this year, this is a digestive type year.
Yes.
I mean, if the market closes up 6, 7, 8%, that's a home run given what we did last year. We borrowed some from last year already. I think this is the perfect year to be buying the dips. You buy your 5 to 10% dips, but you've got to sell some of the rallies. We're not going to return 30+% again.
Right. Well, I mean, yeah, last year was an extraordinary year. Do you want to be putting in there any other asset classes?
I think for sure, we have a big position in commodities. I think I continue to add to the commodity position. I think,
like oil? I mean, look at oil today, 105.
Yeah, and oil's been in this range for years now. We're in a healthy range. If oil gets above, as we talked about earlier, if oil starts ticking at 120, 125, that's going to be a big cautionary sign. I don't think it gets there so quickly, but broad-based commodities, the agriculture complex has been fantastic this year. I think that continues. The REIT area also is one that's kind of percolating now for the next couple of quarters.
I was going to say, you're going to have us back at the end of the year, so we've got a market going here. We're underweight commodities right now, and I think the broad view for us is picking, although you said this, idiosyncratic opportunities. There's a lot of really interesting stuff to look at. We've played palladium, we've played energy. We're actually playing, not getting too geeky, but the backwardation curve again. So the fact that you can actually get a yield roll in commodities is interesting.
Oh, wow. Okay.
Broad commodities that are up right now, they're being driven by the weather. Livestock and...
This program is brought to you by Edward Jones. Join the nearly 7 million investors who know FaceTime and ThinkTime make a difference.
This man has an accomplished research and analytical group at his disposal. But even more impressive is how he puts it to work for his clients.
Morning. Good morning.
Thanks for meeting so early.
Oh, it's not a big deal at all. Come on in.
It's how Edward Jones makes sense of investing.
Up. A short word that's a tall order. Up your game. Up the ante. And if you stumble, you get back up. Up isn't easy, and we ought to know. We're in the business of up. Every day, Delta flies 250,000 people while investing billions, improving everything from booking to baggage claim. We're raising the bar on flying, and tomorrow, we will up it yet again.
No matter what, people can count on me to get the job done. So when my prostate cancer returned, my doctor told me that this time can be different with Provenge, a personalized treatment that lets me count on my own body to fight back.
Provenge is clinically proven to help extend life in certain men with advanced prostate cancer by taking your own blood cells and reprogramming them to jumpstart your immune system so it can attack your prostate cancer. Provenge can cause serious reactions, including those resulting from the infusion and stroke. Severe but infrequent infusion reactions include chills, fever, fatigue, weakness, breathing difficulties like shortness of breath, decreased oxygen and wheezing, dizziness, headache, high blood pressure, muscle ache, nausea, and vomiting. Tell your doctor about all of your medical problems, including heart problems, lung problems, or history of stroke. Call 1-800-843-8193 for more information. Talk to your doctor and find out if the time is right for Provenge. Provenge. Help.
Let me tell you a story about two typical American couples. There's John and Joan who could use some financial help, but they're worried and have some misconceptions about reverse mortgages. Like they might not qualify if they have an existing mortgage and that it could mean giving up their home. But take Sandy and Greg. They're just like John and Joan, but they called AAG and learned that a reverse mortgage was government insured, tax-free, and that they'd always retain complete ownership of their home. They also learned that most people use a reverse mortgage to eliminate their existing monthly mortgage payments, and that AAG is America's trusted reverse mortgage lender with a 93% customer satisfaction rate. So join Sandy, Greg, and 500,000 other Americans.
Call 1-800-660-8341 now to receive a new free information kit, including a reverse mortgage guide and DVD, personal stories from people like you, and a brand new family guide for children and loved ones, all absolutely free with no obligation. Call 1-800-660-8341 today.
Mundo Fox.
Well, welcome back. The 2014 New York Auto Show is here. Nissan Motor Corp is on site to unveil its new 2015 Murano, as well as some new built-in tech features. Andy Palmer is the Chief Planning Officer at Nissan. He joins us live from the show with an inside look at what we can expect from the company this year. Andy, good to see you. Andy, can you hear me?
Sorry, could you say again?
Yeah, I said thanks
yes,
very much. Thanks for joining us. Tell us what you're unveiling.
Everything here is going great. You can tell it's a noisy show in the background, but obviously things are